Have you ever wondered how much of your income actually goes to the government? If so, you're in the right place. We're here to break down the basics of income tax. Income tax, at its core, is a portion of your earnings that you pay to the government. It's not a flat rate for everyone, but rather a progressive system where the percentage of tax you owe increases as your income does. This is where tax brackets come into play. Each bracket represents a range of income and corresponds to a specific tax rate. For example, if you're in the 20% tax bracket, you don't pay 20% on all your income, but only on the income within that bracket's range. Now let's talk about taxable income. This is the amount of your earnings that's subject to tax. Not all of your income is taxable, though. Some of it can be shielded by what we call deductions. Deductions are certain expenses that you can subtract from your gross income to reduce your taxable income. For instance, if you earn $50,000 a year and have $5,000 in deductions, you'll only be taxed on $45,000. But don't confuse deductions with tax credits. While deductions lower your taxable income, tax credits reduce your actual tax bill. Say you owe $3,000 in taxes, but have a $1,000 tax credit. This means you'll only end up paying $2,000. The purpose of income tax is to fund public services and infrastructure. It helps pay for things like education, healthcare, and transportation, among other public goods. With a clear understanding of these basics, you're well on your way to becoming a tax guru. So stay tuned as we delve deeper into the world of income tax in the upcoming segments. Did you know that not all income is taxed the same? That's right, the taxman sees various types of income quite differently. Let's break it down. First up, we have the most common form of income, your salary. This is typically taxed at a standard rate based on your tax bracket. Next is income from business profits. If you're self-employed or own a business, the profit you make is also taxable. However, business owners can often offset their income with business expenses, reducing their overall tax liability. Then there's income from investments, which can come in forms like dividends, interest, and capital gains. These are usually taxed at a different rate than your regular income. Lastly, there are more unique forms of income like royalties or alimony payments, which also have their own tax implications. By understanding these different types of income, you can better strategize your financial decisions. Remember, the type of income you earn can greatly affect your tax bill. Are you taking full advantage of tax deductions and credits? It's a question that should be on everyone's mind as tax season rolls around. Why, you ask? Well, these are tools that can significantly lighten your tax burden. First, let's take a look at tax deductions. These reduce the amount of your income that's subject to taxes. For instance, if you're in the 25% tax bracket and you have a $1,000 deduction, you'll save $250 on your tax bill. Common deductions include the student loan interest deduction, the medical expenses deduction, and the home office deduction. Next up, we have tax credits, which are even more valuable than deductions. While deductions lower your taxable income, credits directly reduce your tax bill. Think of it as a dollar-for-dollar reduction. For example, if you owe $2,000 in taxes and you qualify for a $1,000 tax credit, you'll only owe $1,000. Some common tax credits include the Earned Income Tax Credit, the Child Tax Credit, and the American Opportunity Tax Credit. And let's not forget about exemptions. These are similar to deductions in that they lower your taxable income. However, exemptions typically apply to specific circumstances or types of taxpayers. For example, there's a personal exemption for the taxpayer and dependents, and there are also exemptions for the elderly or blind. As you can see, there are numerous ways to save money on your taxes. But remember, every taxpayer's situation is unique. What works for one person may not work for another. So it's important to do your research or consult with a tax professional to ensure you're getting the most out of your deductions, credits, and exemptions. With knowledge of these deductions and credits, you can maximize your tax savings. So don't leave money on the tax table. Be proactive, be informed, and take full advantage of what the tax code has to offer. Because after all, a penny saved is a penny earned. Confused about the filing process and deadlines? Well, let's clear that up together. Filing your income tax return might seem like a daunting task, but with a little guidance, you'll find it's easier than you think. So where do we start? The process begins with gathering all your financial documents for the previous year. This includes your W-2S, 1099-S, and any other forms that report your income. It's also a good idea to gather records of any tax deductions or credits you plan to claim. Next, you'll need to determine your filing status. Are you single, married filing jointly, married filing separately, or perhaps a head of household? Your status can affect the amount of tax you owe, and in some cases, the types of deductions you can take. Now, it's time to fill out your tax return. You can do this manually using paper forms, or you can use an online tax software, which will guide you through the process step by step. Either way, you'll be inputting information about your income, deductions, and credits. Once you've filled out your return, double-check everything. A small mistake could lead to delays or even an audit. And remember, honesty is always the best policy when it comes to your taxes. After you've reviewed your return, it's time to submit it. If you're using an online service, you can e-file your return. If you're doing it manually, you'll need to mail it to the IRS. Keep a copy of your filed return and all your supporting documents for your records. Now, let's talk deadlines. The deadline to file your taxes is typically April 15th. If you need more time, you can request an extension. But remember, an extension to file is not an extension to pay any tax you owe. So, there you have it, the ins and outs of filing your income tax return. It might seem complex, but with a little preparation and organization, you can tackle it with confidence. Stay organized and ahead of deadlines to avoid any tax filing stress. Worried about making mistakes on your tax return? Let's unravel some common errors that trip people up. First on our list is filing under the wrong status. Your status, whether it's single, married, or head of household, drastically impacts your tax liability. So ensure you're choosing the one that suits you best. Next, we have incorrect or incomplete information. This might seem obvious, but you'd be surprised how often people slip up on their social security number or forget to sign and date their return. Double, no, triple check your forms before sending them off. Here's a big one: not reporting all income. Remember, all income is taxable unless the law specifically excludes it. That includes your side gig earnings, rental income, even your gambling winnings. Overlooking these can invite unwanted attention from the tax authorities. Misunderstanding deduction and credit rules is another common pitfall. Not all expenses are tax deductible, and not all tax credits are refundable. Make sure you understand the rules before you claim. Lastly, we have filing late or not at all. If you owe taxes, not filing or filing late can lead to penalties. If you can't meet the deadline, request an extension. It's better late than never. Avoiding these common mistakes can make your tax season a breeze. Want to optimize your tax situation? Here are some practical tax planning tips to help you do just that. If you're a freelancer, consider establishing a simplified employee pension, or SEP IRA. This allows you to contribute a portion of your net earnings to your retirement savings and deduct these contributions from your taxable income, leading to potential tax savings. For the business owners out there, one effective strategy is to carefully time your income and expenses. By strategically deferring income to the next tax year or accelerating deductible expenses into the current year, you can manage your taxable income and potentially reduce your tax liability. Employees, don't overlook the power of your workplace benefits. Maximize contributions to tax-advantaged accounts like your 401(k) or health savings account. These contributions are often made with pre-tax dollars, reducing your taxable income. For those with investment income, consider tax-efficient investing strategies. This could mean prioritizing investments that generate long-term capital gains, which are typically taxed at a lower rate than ordinary income. Lastly, no matter your income type, consider working with a tax professional. They can provide personalized advice tailored to your specific situation, ensuring you take full advantage of all possible deductions and credits. Implement these tips to optimize your tax situation and save more of your hard-earned money.